Let me tell you something that keeps me up at night when I think about the millions of retirees and soon-to-be retirees watching this. Most of you have been lied to your entire investing lives. You have been told that when you reach 60, when you finally cross that threshold into your golden years, you need to abandon everything you know about building wealth and pivot entirely into bonds. Safe investments, they call them. Conservative allocations, age-appropriate portfolios. And while you have been sitting there collecting your 2 or 3% yields, watching inflation eat away at your purchasing power year after year, the people who actually understand money have been quietly building income streams that pay like clockwork. Income streams that not only preserve your capital, but actually grow it. Income streams that let you sleep soundly at night, knowing that next month and the month after that and the month after that, money will be deposited into your account, whether the market goes up or down or sideways. Today, I am going to share with you the 4 income investments that have served me better than anything else over my decades of investing. These are not speculative plays. These are not risky bets. These are battle-tested, recession-proven, time-honored investments that generate predictable income month after month, year after year, regardless of what happens in the economy. And I am going to explain exactly why each one works, exactly how to implement them, and exactly what kind of income you can realistically expect. But before I reveal these 4 investments, I need you to understand something fundamental about income investing that most financial advisors will never tell you. The financial industry has a vested interest in keeping you confused. They want you to think that generating reliable income in retirement is complicated. They want you to believe you need their expensive actively managed funds, their complex annuity products, their fee-laden advisory services, because every dollar they convince you to pay them is a dollar that comes out of your retirement income. Every percentage point in fees is a percentage point you do not earn. And over a 20 or 30-year retirement, those fees compound into hundreds of thousands of dollars that should have been yours. The truth is that building a reliable income portfolio is not complicated. It requires discipline. It requires patience. It requires the willingness to ignore the noise and stick with proven strategies. But it does not require a PhD in finance or a team of advisors or expensive software. What it requires is understanding 4 simple investment types that have been generating reliable income for decades and having the wisdom to own them in appropriate proportions. Let me take you back to 1974. The stock market had just crashed. The Dow had fallen over 45% from its highs. Inflation was running at 12%. Interest rates were spiking. The economy was in shambles. Everyone was predicting the end of American capitalism. And I remember sitting in my office, looking at the carnage, looking at the fear in everyone's eyes, looking at investors selling everything they own just to get out. And I made a decision that shaped everything I know about income investing. Instead of running away, I started buying not speculative stocks, not growth plays, but solid dividend-paying companies that had been generating income for their shareholders through every crisis in American history. Companies that had paid dividends through the Great Depression, through World War II, through every recession and market crash for 50, 60, even 100 years. And you know what happened? Those dividends kept coming. While everyone else was panicking, while the market was crashing, while the headlines were screaming about the end of the world, those dividend checks kept arriving in my account. Not every month the same amount. Some companies did cut their payouts, but the core of that portfolio, the truly great dividend payers, they kept sending money. And when the market eventually recovered, as it always does, I owned more shares than I would have if I had panicked and sold. More shares meant more dividends. More dividends meant more income. And the compounding effect of reinvesting those dividends during the crash turned a good portfolio into an exceptional one. That experience taught me the most important lesson in income investing. You do not need the market to go up to make money. You do not need capital gains. You do not need to time the market perfectly or pick the next hot stock. What you need is a portfolio of investments that pays you reliably, regardless of market conditions. What you need is income that arrives like clockwork, month after month, quarter after quarter, year after year. And that is exactly what I'm going to teach you today. The first income investment that pays like clockwork is dividend growth stocks. Now I know what some of you are thinking. Stocks? You want me to own stocks at my age? Every financial advisor I have ever met has told me to reduce my stock exposure as I get older. And I understand that instinct. Stocks are volatile. They go up and down. Watching your portfolio drop 20 or 30% during a market crash is painful, especially when you are retired and do not have decades to recover. But here is what those advisors do not tell you. Not all stocks are created equal. There is a massive difference between owning speculative growth stocks that pay no dividends and owning blue chip dividend aristocrats that have increased their payouts every year for 25, 50, even 60 years straight. These are not the same investment. They are not even in the same universe of risk. Let me explain what I mean by dividend aristocrats. These are companies in the S&P 500 that have increased their dividend every single year for at least 25 consecutive years. Think about what that means. These companies have raised their dividend through the dot-com crash, through the 2008 financial crisis, through the COVID pandemic, through every recession, every bear market, every economic disaster for a quarter century. They did not just maintain their dividend, they increased it every single year. That is an incredible track record of reliability. And here is what makes these investments truly powerful for retirees. The income grows. If you buy a stock yielding 3% today, and that company increases its dividend by 7% per year, in 10 years, your yield on cost is over 5.8%. In 20 years, it is over 11%. You are earning 11% annually on your original investment, not because the stock price went up, but because the company kept raising its dividend. This is how you stay ahead of inflation. This is how you maintain your purchasing power through a long retirement. This is how you build a rising income stream that keeps pace with rising costs. Now, let me give you some specific examples of the kinds of companies I am talking about. Coca-Cola has paid increasing dividends for over 60 consecutive years. Procter & Gamble has done the same for nearly 70 years. Johnson & Johnson, similar track record. These are not sexy investments. They are not going to double in a year. Your neighbor's not going to be impressed when you tell him you own Coca-Cola, but that is exactly the point. These are boring, predictable, reliable businesses that generate enormous amounts of cash flow and return that cash to shareholders through steadily increasing dividends. Let me tell you a story about a friend of mine who retired in 1985. He had accumulated about $200,000 in savings, which was a decent amount back then. His financial advisor wanted to put him entirely into bonds and certificates of deposit. Safe investments, the advisor said, appropriate for your age. But my friend had been watching what I was doing, and he asked me for advice. I told him to put half his money into dividend-paying stocks, the kinds of companies we have been talking about, companies with long histories of raising their dividends. His advisor thought he was crazy. Stocks are risky, the advisor said. You could lose everything. But my friend trusted me, and he made the investment. He put $100,000 into a diversified portfolio of dividend aristocrats. Now, fast forward 40 years to today, that $100,000 investment is worth over $2 million. But more importantly, the dividends. In 1985, his portfolio generated about $4,000 in annual dividend income. Today, that same portfolio generates over $120,000 in annual dividends. His income has grown 30-fold, far outpacing inflation. He never sold a single share. He just held on and let the companies do what great companies do, grow their earnings and share the profits with shareholders. Meanwhile, if he had followed his advisor's advice and put everything into bonds yielding 8% back in 1985, he would have earned $8,000 per year. But bond yields do not grow. When those bonds matured, he would have had to reinvest at lower rates. Today, with rates where they are, his bond portfolio would be generating maybe $50,000 per year, half of what his dividend portfolio generates. And the purchasing power of that $50,000 would be a fraction of what $8,000 bought in 1985. Inflation destroyed the value of the safe investment while the risky investment made him wealthy. This is the power of dividend growth investing. It is not about getting rich quick. It is about getting rich slowly and surely with growing income that lets you maintain your lifestyle regardless of what happens in the economy. The key to making dividend growth stocks work in retirement is understanding that you are not investing for capital gains. You do not care if Coca-Cola stock goes up 20% next year. You care if Coca-Cola increases its dividend next year. Those are different things. And when you shift your mindset from price appreciation to income generation, you start to see these investments differently. A market crash becomes an opportunity to buy more shares at lower prices, which means more dividend income. A flat market is fine because your income keeps growing even when prices do not. You become immune to the daily noise because you are focused on the only thing that matters, the cash that flows into your account. For someone over 60 looking to build an income portfolio, I would suggest allocating a meaningful portion to dividend growth stocks. You want companies with at least 25 years of consecutive dividend increases. You want companies with payout ratios below 60%, meaning they are not paying out more than they can afford. You want companies with strong balance sheets and low debt. And you want companies in industries that generate steady cash flow regardless of economic conditions. Consumer staples, healthcare, utilities. These are the sectors where you find the most reliable dividend growers. The yield on a portfolio of dividend aristocrats today is roughly 2.5% to 3%. That might not sound like much compared to what you can get in bonds or CDs right now. But remember, that yield grows. If you are getting 3% today and it grows by 7% annually, in 10 years, you're getting almost 6% on your original investment. In 15 years, you are getting over 8%, and you still own the shares, which have likely appreciated as well. The total return from dividend growth stocks has historically exceeded the total return from bonds over long periods, with the added benefit of growing income. Let me share some specific criteria I use when selecting dividend stocks for an income portfolio. First, I look at the dividend track record. Has the company increased its dividend for at least 25 consecutive years? If yes, that tells me management is committed to returning cash to shareholders and has the discipline to maintain that commitment through thick and thin. Second, I look at the payout ratio. This is the percentage of earnings paid out as dividends. I want to see a payout ratio below 60%, ideally below 50%. That gives the company room to grow the dividend even if earnings hit a rough patch. Third, I look at the balance sheet. I want to see low debt relative to equity. Companies with too much debt are vulnerable in recessions and may have to cut dividends to service their debt. Fourth, I look at the business model. Is this a company selling products and services that people need regardless of economic conditions? Consumer staples companies selling food and household products tend to be more stable than luxury goods companies or cyclical industrials. Fifth, I look at competitive advantages. Does this company have a brand, a patent portfolio, a distribution network, or some other moat that protects it from competition? The best dividend stocks are companies with sustainable competitive advantages that can maintain pricing power and profitability for decades. The second income investment that pays like clockwork is real estate investment trusts, commonly known as REITs. These are companies that own and operate income-producing real estate. Apartment buildings, shopping centers, office towers, industrial warehouses, data centers, cell towers. The beauty of REITs is that they are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This legal requirement creates a structural advantage for income investors. These companies cannot hoard cash. They have to pay it out. Now, I need to be careful here because not all REITs are created equal. Some types of real estate are struggling and will continue to struggle. Office buildings, as I have discussed before, face serious headwinds from remote work. Many retail REITs are dealing with a shift to e-commerce. You need to be selective about which REITs you own. But the best REITs, the ones in growing sectors with strong management teams and conservative balance sheets, these can be incredible income generators. Let me give you some examples of the types of REITs that I find most attractive for income investors.
First, consider residential REITs that own apartment buildings. People always need somewhere to live. And in many parts of the country, there is a structural shortage of housing that will take years to resolve.
Demand for apartments remains strong, especially in growing cities with good job markets.
The best apartment REITs have been able to raise rents consistently, which translates into rising dividends for shareholders.
I have been watching the housing market for over 50 years, and the shortage we face today is unlike anything I have seen. Building costs have skyrocketed. Regulatory hurdles have multiplied. Young people cannot afford to buy homes, so they rent longer. Immigration is increasing demand in major cities. All of these factors point to sustained demand for rental housing and sustained pricing power for apartment owners. The best residential REITs are essentially monopolies in their local markets. There is only so much land, there are only so many buildings, and the demand keeps growing. Second, consider industrial and logistics REITs. These own the warehouses and distribution centers that power modern commerce. Every time you order something online, it probably passes through a building owned by one of these REITs. The growth of e-commerce has been a massive tailwind for industrial real estate, and that trend shows no signs of slowing. The best industrial REITs have achieved occupancy rates above 97% and have been raising rents at healthy clips. Let me tell you why I find industrial real estate so compelling. The shift to e-commerce requires roughly 3 times as much warehouse space as traditional retail. If a retailer had 100,000 square feet of retail stores, they need 300,000 square feet of warehouse space to serve the same customers online. This is because e-commerce requires more inventory storage, more sorting and packing space, and faster delivery times, which necessitate more facilities closer to population centers. As e-commerce continues to grow, demand for industrial real estate grows even faster. This is a secular trend that will play out over decades. Third, consider data center REITs. These own the facilities that house the servers powering the internet, cloud computing, artificial intelligence, and virtually everything we do online. Data demand is growing exponentially, and these facilities are critical infrastructure for the modern economy. The best data center REITs have seen strong demand growth and have pricing power that allows them to raise rents consistently. The explosion of artificial intelligence has supercharged demand for data centers. These AI models require enormous amounts of computing power, which requires enormous amounts of server space. The major technology companies are spending tens of billions of dollars building AI infrastructure, and much of that spending flows to data center operators. This is not a temporary trend. This is the beginning of a fundamental shift in how computing is done, and it will drive demand for data center space for years to come. Fourth, consider cell tower REITs. These own the towers that wireless carriers need to provide cellular service. Every time you make a call, send a text, or use mobile data, you are using infrastructure owned by these companies. The wireless carriers sign long-term leases with built-in rent escalators, providing visibility into years of future income growth. And as data demand grows with 5G and beyond, the need for cell tower infrastructure only increases. What I love about cell tower REITs is the visibility of their income. These companies have leases that extend for 15 or 20 years with annual rent increases built in. You can look at their lease book and see exactly what their revenue will be for the next decade. There is no guessing, no speculation. The income is contractually guaranteed. And the switching costs for wireless carriers are enormous. Once a carrier has its equipment on a tower, moving it is expensive and disruptive. So these relationships tend to last for decades. What I love about REITs is the visibility of the income. Because these companies own real assets with long-term tenants, you can see the lease agreements, you can see when they expire, you can see the rent escalators built into the contracts. This gives you confidence that the income will continue. It is not dependent on some speculative business model or unproven technology. It is dependent on tenants paying rent, which they have been doing for decades. The yields on quality REITs typically range from 3 to 6%, depending on the sector and the specific company. That is higher than you will get from most dividend stocks. And many of the best REITs have track records of increasing their dividends annually, giving you the combination of high current income and growing future income. One caution about REITs: they tend to be sensitive to interest rates. When rates rise, REIT prices often fall because investors can get higher yields elsewhere and because higher rates increase borrowing costs for real estate companies. This creates volatility. But For income investors, this volatility can be an opportunity. When REIT prices fall, yields rise. If the underlying real estate and tenants are solid, a price decline is a chance to lock in higher yields. Do not let price volatility scare you away from great REITs. Focus on the income, focus on the quality of the real estate and tenants, and let the market price fluctuate. I want to share a specific example of how REITs have built wealth for income investors. In 2004, you could have bought shares of a leading industrial REIT for about $35 per share. The dividend was about $1.40 per share annually, a yield of 4%. That same REIT today trades for about $150 per share and pays a dividend of about $6.50 per share annually. Your $1.40 in annual income has grown to $6.50, an increase of over 360%. And your $35 investment is now worth $150. That is a total return of over 500% in 20 years, with most of that return coming from growing dividends that you could spend along the way. This is what quality REIT investing looks like. The third income investment that pays like clockwork is high-quality corporate and municipal bonds. Now, I have been critical of long-duration Treasury bonds in the past, and I stand by that criticism. Buying 30-year Treasuries at current rates is a recipe for disappointment when you factor in inflation and the potential for rates to rise further. But that does not mean all bonds are bad. Far from it. Short and intermediate-term bonds from high-quality issuers can play an important role in an income portfolio. Let me explain the distinction. When you buy a bond, you are lending money to the issuer in exchange for interest payments and the return of your principal at maturity. The risk you face is that the issuer defaults and cannot pay you back, or that interest rates rise and your bond loses value before maturity. The way to manage these risks is by focusing on high-quality issuers who are unlikely to default and by keeping your maturities short enough that interest rate changes do not devastate your portfolio. For retirees seeking income, I particularly like investment-grade corporate bonds with maturities between 1 and 7 years. These are bonds issued by financially strong companies with low default risk. Companies rated A or higher by the major credit agencies have historically had default rates below 1% over 10-year periods. That means if you own a diversified portfolio of these bonds, you can collect your interest payments with high confidence that you will get your principal back at maturity. The yields on investment-grade corporate bonds are currently quite attractive by historical standards. You can find quality companies paying 4 to 5% on bonds maturing in 3 to 5 years. That is real income that arrives predictably twice per year. And because the maturities are relatively short, you are not taking enormous interest rate risk. If rates rise further, your bonds will decline somewhat in value, but you will get your principal back at maturity and can reinvest at the higher rates. Let me explain the concept of a bond ladder, which is the most effective way to manage a bond portfolio for income. A bond ladder is simply a collection of bonds with staggered maturities. You might have bonds maturing each year for the next 7 years. As each bond matures, you reinvest the principal into a new bond at the long end of your ladder. This gives you regular access to your principal if you need it and allows you to continually reinvest at current rates. If rates rise, your maturing bonds can be reinvested at higher yields. If rates fall, you still have your longer dated bonds locked in at the old higher rates. Here is a specific example. Say you have $350,000 to invest in bonds. You could buy $50,000 worth of bonds maturing in each of the next 7 years. Year 1, you have $50,000 maturing. Year 2, another $50,000. And so on through year 7. Each year as a bond matures, you take that $50,000 and buy a new 7-year bond. This keeps your ladder constant at 7 rungs and ensures you always have bonds maturing within the next 12 months if you need access to capital. The beauty of this approach is that you are never forced to sell bonds at a loss. If rates rise and your longer-dated bonds decline in value, so what? You hold them to maturity and get your principal back. Meanwhile, your maturing bonds can be reinvested at the new higher rates. You get the best of both worlds, stable income today with the ability to capture higher rates tomorrow. For investors in higher tax brackets, municipal bonds can be even more attractive. Municipal bonds are issued by state and local governments to fund infrastructure projects, schools, hospitals, and other public purposes. The interest payments on most municipal bonds are exempt from federal income tax and often from state and local taxes as well. This tax advantage can make the after-tax yield on municipal bonds higher than the after-tax yield on corporate bonds or treasuries, even though the stated yield is lower. Let me give you an example. Say you are in the 32% federal tax bracket and you are comparing a corporate bond yielding 5% to a municipal bond yielding 3.5%. The corporate bond pays you 5%, but after federal taxes, you keep only 3.4%. The municipal bond pays you 3.5%, and you keep all of it because it is tax exempt. The municipal bond actually gives you more after-tax income, even though its yield looks lower. And if you are in a state with high income taxes, the advantage is even greater. The key with municipal bonds is focusing on quality. General obligation bonds backed by the full taxing authority of a state or municipality are generally safer than revenue bonds backed by specific projects. And you want to focus on issuers with strong finances. Not every city or state is in good fiscal shape. Some have underfunded pensions, declining populations, or structural budget problems. Do your homework or invest through a well-managed municipal bond fund that does the credit analysis for you. One of the things I love about bonds for retirees is the predictability. When you buy a bond, you know exactly what your income will be and exactly when you will receive it. There are no earnings surprises, no dividend cuts, no management changes. The company or government owes you money and they have to pay it according to the terms of the bond. This predictability can be psychologically important in retirement. You can look at your bond portfolio and know with high confidence what income you will receive over the next year, the next 5 years, the next 10 years. That certainty allows you to plan your spending and live your life without constantly worrying about whether your investments will produce enough income. The fourth income investment that pays like clockwork is preferred stocks. These are a hybrid security that sits between common stocks and bonds in a company's capital structure. Preferred shareholders receive fixed dividend payments, typically paid quarterly, that must be paid before any dividends can be paid to common shareholders. In the event of bankruptcy, preferred shareholders have a higher claim on the company's assets than common shareholders, though they still rank below bondholders. Preferred stocks are often overlooked by individual investors, but they can be excellent income generators. The yields on preferred stocks are typically higher than the yields on common stocks or investment-grade bonds. You can often find preferred stocks from solid companies yielding 5 to 7%. That is meaningful income that can make a real difference in your retirement cash flow. Let me explain how preferred stocks work. When a company issues preferred stock, it agrees to pay a fixed dividend, usually stated as a percentage of the par value. For example, a preferred stock with a $25 par value and a 6% coupon would pay $1.50 per year, typically in quarterly installments of 37.5 cents. This dividend is fixed. It does not change based on the company's profits or the whims of the board of directors. It is a contractual obligation. Most preferred stocks are cumulative, meaning if the company misses a dividend payment, it has to make it up later before paying any dividends to common shareholders. This provides an extra layer of protection. The company cannot just skip your dividend and never pay it. They owe you that money and have to pay it eventually. Preferred stocks do have some risks you need to understand. First, they are usually callable, meaning the company can redeem them at par value after a certain date. If interest rates fall, companies often call their high-yielding preferred stocks and issue new ones at lower rates. This means you might not be able to hold your preferred stock forever. You might get your principal back earlier than expected and have to reinvest it at lower yields. Second, preferred stock prices can be volatile, especially when interest rates change. Like bonds, preferred stocks tend to fall in price when rates rise because the fixed dividend becomes less attractive compared to higher-yielding alternatives. If you need to sell your preferred stocks before they are called, you might receive less than you paid. Third, preferred stocks are subordinate to bonds in the capital structure. If a company gets into serious financial trouble, bondholders get paid before preferred shareholders. In a bankruptcy, you might lose all or most of your investment. The way to manage these risks is by focusing on preferred stocks issued by financially strong companies and diversifying across many issuers. Banks and utilities are common issuers of preferred stocks, and there are many high-quality options in these sectors. You can also invest through preferred stock ETFs or mutual funds that provide diversification and professional management. Let me tell you about a specific strategy I have used successfully with preferred stocks. During the 2008 financial crisis,
Preferred stocks from major banks were trading at massive discounts to their par values.
Preferreds that would normally trade at $25 were selling for $10 or $12. The yields based on those low prices were extraordinary, sometimes exceeding 15 or 20%. Now, there was real risk. Some banks did fail, and their preferred shareholders lost everything. But the banks that survived, the ones that were too big to fail and received government support, their preferred stocks eventually recovered to par value. Investors who bought those preferreds at $10 and held them collected huge yields for years and then made 150% capital gains when the preferreds were called at $25. This is why I say volatility is the friend of the income investor. When preferred stock prices crash because of fear and uncertainty, yields spike. If you have the courage to buy quality preferreds during a crisis and the patience to hold them, you can lock in extraordinary income and make capital gains to boot. For retirees seeking income, I like preferred stocks because of their high yields and quarterly dividend payments. A portfolio of quality preferred stocks can generate 5 to 6% income with reasonable safety. That is 100% more income than you would get from treasury bonds. And while preferred stocks can be volatile if you hold them for income rather than capital gains, the price fluctuations matter less. What matters is that the dividend checks keep arriving. Now let me talk about how to put these 4 investments together into a cohesive income portfolio. The right allocation depends on your specific situation, your risk tolerance, your tax bracket, and your income needs. But let me give you a framework for thinking about it. If you are 60 years old and still have a long retirement ahead of you, perhaps 25 or 30 years, you can afford to have a larger allocation to dividend growth stocks. These provide the growing income that will help you stay ahead of inflation over the decades. Maybe 50% of your portfolio in dividend growth stocks, 20% in REITs, 20% in bonds, and 10% in preferred stocks. This gives you a current yield of roughly 3.5% to 4% with significant income growth potential. If you are 70 years old and more focused on capital preservation and current income, you might shift the allocation. Maybe 30% in dividend growth stocks, 20% in REITs, 30% in bonds, and 20% in preferred stocks. This gives you a higher current yield of roughly 4 to 4.5% with less volatility. If you are 80 years old and prioritizing stability above all else, you might lean even more heavily toward bonds and preferred stocks, maybe 20% in dividend growth stocks, 15% in REITs, 40% in bonds, and 25% in preferred stocks. This gives you a portfolio yield of roughly 4.5% to 5% with significant stability. But here is the most important thing I want you to understand. The specific percentages matter less than the principle. The principle is that you want a diversified portfolio of income-generating assets that pay you reliably, regardless of market conditions. You want some growth potential from dividend stocks and REITs to stay ahead of inflation. You want some stability from bonds and preferred stocks to dampen volatility. And you want enough yield to meet your spending needs without depleting your capital. Let me share with you a case study that illustrates how powerful this approach can be. Imagine you retired in 2000 with $1 million and used this income-focused approach. You allocated 40% to dividend growth stocks, 20% to REITs, 25% to bonds, and 15% to preferred stocks. Your initial portfolio yield was roughly 4%, generating $40,000 in annual income. Now imagine you spent that $40,000 each year to cover your living expenses. You did not reinvest the dividends. You spent them. That is the whole point of an income portfolio in retirement. But even though you were withdrawing income, your portfolio still grew. The dividend stocks increased their payouts and appreciated in value. The REITs raised their distributions and grew their net asset values. The bonds paid their coupons reliably. The preferred stocks sent their quarterly checks. 25 years later, that $1 million portfolio is worth approximately $1.8 million, even after withdrawing income every year. And your annual income has grown from $40,000 to approximately $75,000 because the dividend stocks and REITs increased their payouts. You have more income and more capital than when you started, despite spending the income along the way. That is the power of income investing done right. Compare that to someone who followed the conventional advice and put their entire portfolio into bonds yielding 6% in 2000. They also received $60,000 in the first year. but bond yields do not grow. As their bonds matured and they reinvested at lower and lower rates during the 2000s and 2010s, their income declined. 25 years later, they are receiving maybe $40,000 per year from their bond portfolio. And that $40,000 has lost half its purchasing power to inflation. They can buy half as much as they could 25 years ago. And their portfolio has not grown either, because bonds do not appreciate the way stocks do over long periods. They followed the safe advice and ended up with a worse outcome. This is why I am so passionate about teaching people the right way to invest for income. The conventional wisdom is wrong. Playing it too safe can actually be dangerous. You need growth in your income to maintain your standard of living over a long retirement. And you need appreciation in your capital to sustain that income growth. A properly constructed portfolio of dividend stocks, REITs, bonds, and preferred stocks gives you both. Now, let me address some common concerns and questions that people have about income investing. First, what about taxes? Income investments do generate taxable income, which can be a concern for some investors. The key is using the right accounts and choosing tax-efficient investments. Dividend stocks that pay qualified dividends are taxed at preferential rates, currently 15% for most taxpayers. REITs pay ordinary dividends that are taxed at your regular income rate, so they are better held in tax-advantaged accounts like IRAs if possible. Municipal bonds provide tax-free income, making them ideal for taxable accounts if you are in a high tax bracket. Preferred stock dividends are usually qualified and taxed at preferential rates. By being thoughtful about which investments you hold and which accounts, you can minimize your tax burden and keep more of your income. Second, what about inflation? This is why dividend growth stocks and REITs are so important. Companies that raise their dividends are giving you a built-in inflation hedge. If inflation runs at 3% and your dividends grow at 7%, you are gaining purchasing power. If you only own bonds with fixed yields, inflation would erode your standard of living over time. The growth component of your portfolio is essential for maintaining your lifestyle over a long retirement. Third, what about market crashes? Yes, your portfolio will decline in value during market crashes. That is unavoidable if you own stocks and REITs. But here is what matters. During the 2008 financial crisis, one of the worst in modern history, the dividend aristocrats continued paying their dividends. Some cut their payouts, but the best companies, the ones with fortress balance sheets and essential businesses, kept paying and even kept raising their dividends. If you owned those companies for income, you still received your checks. You could pay your bills. You could cover your expenses. The price of the stock fell, but the income kept flowing. And within a few years, the prices recovered and reached new highs. If you panicked and sold during the crash, you locked in losses. If you held on and kept collecting your dividends, you came out fine. Fourth, how do I get started? If you do not already have an income portfolio, the best approach is to transition gradually. Do not sell everything you own and buy all new positions at once. That creates unnecessary risk and potential tax consequences. Instead, as your current holdings throw off dividends or as bonds mature, redeploy that capital into income-generating investments. Build your dividend stock positions over time, add REIT exposure gradually, build your bond ladder one rung at a time. The goal is to be fully allocated within 2 to 3 years, not 2 to 3 weeks. Fifth, should I manage this myself or hire an advisor? If you have the interest and discipline to do it yourself, you can save significant money on advisory fees. The investments I have described are not complicated. You can buy dividend stocks, REITs, bonds, and preferred stocks through any major brokerage. You can research dividend histories online. You can look up bond credit ratings. The information is all available. But if you do not want to manage your own portfolio, or if you lack the discipline to stick with a plan during volatile markets, a good fee-only financial advisor can help. Just make sure they are actually a fiduciary acting in your interest, not a salesperson trying to put you in high-fee products. Let me share one more story that I think really illustrates the power of this approach. I know a couple who retired in 1995 with about $800,000. They were nervous about the stock market. They had watched the crash of 1987 and it had scared them. Their instinct was to put everything into certificates of deposit and treasury bonds. But they talked to me and I persuaded them to try something different. I suggested they put half their money into dividend stocks, about 20% into REITs, and keep the rest in bonds and cash. A balanced income portfolio, just like what I have been describing today. For the first few years, they were anxious. The stock market went up and down. There were scary headlines. There were moments when they questioned whether they had made the right decision. But they stuck with a plan. And the dividends kept coming. Every quarter, like clockwork, money arrived in their account. Then came the 2000 dot-com crash. The market fell over 40%. Their portfolio dropped in value significantly. They called me in a panic. Should we sell? Should we get out? I told them to look at their income. Had the dividend checks stopped coming? No. Had the REIT distributions disappeared? No. Had the bond interest payments ceased? No. The income was still flowing. All that had changed was the price that other people were willing to pay for their investments. They held on. And within a few years, their portfolio had recovered. And the income had actually grown because many of the companies they owned had continued raising their dividends even during the market downturn. Then came 2008, another crash, another phone call, another moment of fear. This one was worse. The financial system seemed to be collapsing. Banks were failing. The news was apocalyptic. But again, I asked them to focus on the income. And again, while some companies did cut dividends, the core of their portfolio continued paying. They held on. They collected their income. And when the recovery came, they were wealthier than ever. That couple is in their late 80s now. Their original $800,000 portfolio is worth over $3 million. And their annual income has grown from about $40,000 in 1995 to over $130,000 today. They have never had to worry about money in retirement. They have traveled the world. They have helped their grandchildren with college. They have donated to causes they care about. And they sleep soundly every night knowing their income is secure. That is what this approach can do. That is why I am sharing these strategies with you, because I have seen it work over and over again for decades through every market environment imaginable. Now, let me talk about some common mistakes I see people make when trying to build an income portfolio. The first mistake is chasing yield. Some investors look at a stock or a REIT or a bond that is yielding 10 or 12%, and they think they have found a gold mine. But in investing, if something seems too good to be true, it usually is. An abnormally high yield is often a warning sign that something is wrong. The market is telling you that it does not believe the dividend is sustainable. Often these high-yielding investments cut their dividends, and when they do, the stock price crashes too. You end up with less income and less capital. Always ask yourself why the yield is so high. Is it because the company has fallen out of favor unfairly, or is it because the business is deteriorating and the dividend is at risk? The second mistake is lack of diversification. Some investors fall in love with a particular stock or a particular sector, and they concentrate their portfolio too heavily. This is dangerous because no matter how confident you are, you can be wrong. Even the best companies can stumble. Even the strongest sectors can face unexpected challenges. If you have 50% of your portfolio in one stock and that stock cuts its dividend, you have just lost half your income. Diversification protects you from this kind of catastrophic outcome. Own at least 20 dividend stocks across multiple sectors. Own at least 5 different REITs. Build a bond ladder with many different issuers. Spread your bets so that no single failure can devastate your retirement. The third mistake is ignoring quality. When interest rates are low and yields are hard to find, there is a temptation to reach for yield by buying lower quality investments. Junk bonds instead of investment grade. Troubled companies instead of blue chips. Leverage REITs instead of conservative ones. This is a recipe for disaster. In the pursuit of a few extra percentage points of yield, you are taking on enormous additional risk. The quality companies will be around in 10 years. The troubled companies might not be. Stick with quality even if it means accepting a slightly lower yield. The fourth mistake is not reinvesting when you should. If you are still in the accumulation phase, if you do not need the income to live on yet, you should be reinvesting every dividend and interest payment. This is how you harness the power of compound interest. This is how you turn a modest investment into a substantial one. Every dividend that gets reinvested buys more shares, which generates more dividends, which buys more shares. Over 20 or 30 years, this compounding effect is enormously powerful. Do not start spending your income before you need to. The fifth mistake is panic selling during market crashes. I have addressed this already, but it bears repeating because it is the most costly mistake investors make. When the market crashes and your portfolio value drops, the temptation to sell is overwhelming. The fear is real. The headlines are scary. Everyone around you is selling. But if you sell during a crash, you lock in your losses permanently. You convert a temporary decline into a permanent destruction of wealth, and you miss the recovery that always comes. The income investor has an advantage here because they can focus on the income rather than the price. As long as the dividends keep coming, the crash is just noise. Hold on, keep collecting your income, wait for the recovery. Let me also talk about the psychological aspects of income investing because psychology is just as important as strategy. One of the greatest benefits of an income portfolio is peace of mind. When you know that your income is secure, when you can see the dividends and interest payments flowing into your account month after month, you experience a kind of financial peace that is hard to describe. You stop worrying about the market. You stop checking stock prices obsessively. You stop reacting emotionally to every piece of news. You have confidence that your financial needs will be met regardless of what happens in the broader economy. This peace of mind has real value. Stress about money is one of the leading causes of health problems in retirees. Financial anxiety can ruin your retirement even if you have plenty of money. But when you have reliable income, when you know the checks will keep coming, that anxiety disappears. You can focus on enjoying your retirement instead of worrying about your retirement. Another psychological benefit is the satisfaction of watching your income grow. Every time one of your companies raises its dividend, every time one of your REITs increases its distribution, you get a little boost of pleasure. You are making progress. Your financial situation is improving. This is much more satisfying than watching stock prices bounce around because stock prices are largely outside your control. But your income is something you can directly measure and track. Over time, as you see your income grow from $40,000 to $50,000 to $60,000 to $70,000, you have tangible evidence that your strategy is working. That is motivating. That keeps you committed to the plan. Let me give you some final thoughts on why income investing is so important, especially for those of you over 60. When you are young and accumulating wealth, total return is what matters. You want your investments to grow as much as possible. You can afford volatility because you have decades to recover from setbacks. You can reinvest all your dividends and let compounding work its magic. But when you are retired or approaching retirement, the equation changes. You need your investments to provide for your daily life. You need money for groceries and utilities and healthcare and travel and grandchildren and all the things that make retirement enjoyable. You cannot eat total return. You cannot pay your electric bill with unrealized capital gains. You need cash, you need income, and you need that income to be reliable. This is why income investing is not just a strategy, it is a lifestyle. It is a way of thinking about money that prioritizes cash flow over capital gains, reliability over excitement, substance over speculation. It is not glamorous. You will not impress anyone at cocktail parties by telling them you own Procter & Gamble for the dividend. But you will sleep well at night knowing that your income is secure. You will enjoy your retirement without constantly worrying about the stock market. And you will likely end up with more wealth than if you had chased hot stocks or followed the latest investment fads. I have spent my career studying what works in investing and what does not. I have seen countless strategies come and go. I have seen fortunes made and lost. And the one constant, the one strategy that has worked through every market environment is owning quality assets that generate reliable income. That is what the 4 investments I have shared with you today represent. Dividend growth stocks, REITs, high-quality bonds, and preferred stocks. Each one has a long track record of paying investors like clockwork. Together, they form a portfolio that can sustain you through decades of retirement. The choice is yours. You can follow the conventional wisdom, pile into bonds, accept meager yields, and watch inflation erode your purchasing power year after year. Or you can take a more thoughtful approach, build a diversified income portfolio, and enjoy growing income that keeps pace with your needs. One path leads to anxiety and declining living standards. The other path leads to financial peace and retirement security. I know which path I would choose. I know which path has worked for me and for every successful income investor I have known. And now you know it too. The 4 income investments that pay like clockwork. Dividend growth stocks for growing income. REITs for high current yield and inflation protection. Bonds for stability and predictability. Preferred stocks for enhanced income and diversification. This is not complicated. This is not rocket science. This is straightforward, time-tested, proven investing that anyone can implement. The only question is whether you will actually do it. Whether you will take this knowledge and put it into action. Whether you will build the portfolio that will sustain you for the rest of your life. I believe you will. I believe that anyone smart enough to watch this video and learn these principles is smart enough to implement them. And I believe that when you see those dividend checks arriving like clockwork, when you see your income growing year after year, when you experience the peace of mind that comes from financial security, you will understand why this approach is so powerful. That is what I want for you. Not just knowledge, but results. Not just information, but transformation. A retirement where you have enough, where your income covers your needs, where you can focus on what really matters, your health, your family, your passions, without constantly worrying about money. The 4 income investments that pay like clockwork can give you that retirement. They have given it to me. They have given it to countless investors who came before you, and now they can give it to you too.